Good morning.
Okay, guys, you should be able to see my screen now. If you cannot, let me know, but hopefully you can. We're going to get started. Welcome to the February 2026 industry update as a part of our Level Up series. And I'm so excited. We've got lots to cover today. And we're going to be talking about the housing market. We're going to be talking about the economy. And hopefully you're going to leave with something that you can apply to your business immediately. And I'll go through questions in the chat log at the end. If you have questions or comments, feel free to put them in the chat. Okay, so let's get to it. Perspective gives you hope and a strategy. This really is the goal today, you guys, is perspective. I really find that when you look at the economy and the data with the housing market, perspective is so important for yourself as you're building your business. Keep yourself motivated, encouraged, and focused on the right things. And it's also really important when you're talking with your clients. And so, my goal is to give you perspective so that you can give it to your clients. Clients often, as we probably all know, are listening to pretty much just whatever they hear on the news cycle and on social media. And that's most often not right, right? Not always right. It's often incorrect, or at least very different compared to the Charlotte market versus the national market. And our goal here is to get clarity and perspective to empower yourself and your clients. And even beyond that, my goal for you is to help you become the local economist of choice. The more volatile the market is, the more people are going to look for you. And this is your opportunity to show up a step above and a step ahead the rest of the competition because of this statement right here, which I love this statement, you guys. This has always empowered me so much in my business. I hope it can empower you too. The economy does not dictate your success. It dictates your strategy and how you communicate to your customers, your buyers, your sellers, your investors, your friends, your vendors, people in your community, and you. And so, your failure or success in this industry, the beauty of it is that it is your choice. You get to decide how you approach your business every day, whether you empower yourself or allow yourself to get sucked into a hole that does not serve you. And so, let's use this data today to change your strategy where needed, adjust as needed, and not worry about the things that maybe don't worry as much, right? If you stop at every obstacle that pops in your world, you're never going to make it anywhere because you'll be too focused on obstacles and things that could slow you down and end up worrying about things that might not ever come to fruition. And so in this industry more than ever, I feel like right now in our economy and just generally in the world of real estate, so much competition. You must be the economy of choice in your world and understand this stuff really more than ever. And so my goal today is we're going to break this down in a way that's simple, that empowers you to go and share this with the people around you. So let's get into it. These are your magic numbers. Now, this is like my favorite. I don't know about you guys, but when I first was learning about the data and numbers of this industry, this formula empowered me so much because 2246 is your magic numbers. And if you know these at any given day, you could go Google these and truly be able to inform yourself and your clients at a high level, just knowing these numbers. So these are your magic numbers. Our goal always is for, generally speaking, in the United States, for GDP to be at 2%, inflation to be at 2%, real estate appreciation to be at 4%, and unemployment to be below 6%. That's the formula for a happy economy and for things to be clicking along. If we stay at these numbers, everything is typically smooth and good. When it's not, that's when we get out of whack and start having problems. And so those are the numbers to always be consistently looking at. And we're going to look at them today as well. So remember those. That's it. 2246. So the first of those numbers that we're going to look at today is US GDP. This is direct from Goldman Sachs. I love Goldman Sachs. They're always super accurate and their data is phenomenal. So, and by the way, you'll get these slides as well, so you can use them. But I'm going to break this down really simple. I don't know about y'all, but like, I went to school for business and marketing, and I'm a people person. I'm not really like naturally a data person. And so this stuff was very intimidating to me when I was first learning about it. So I'm just going to pretend you might be in that same boat. So what we're looking at when we look at GDP Essentially, we're looking for, is the economy growing or contracting? GDP is the measurement, if you don't know, it's the measurement of all goods and services consumed by our country minus the difference between imports and exports. We want GDP to grow on an annual basis. That means that we are growing, right? We want GDP when it's growing, that means businesses are improving, houses are worth more. We're able to pay employees more over time and keep up with natural inflation. So that's why GDP is super important. Our GDP annual percentage right now, as of February 2026, is at 2.5%. Now remember 2246, the goal is for GDP to be right around 2%. So we are right there in that ballpark. Goldman Sachs research projects US GDP growth of about 2.5%. Well, it is that right now. And they're predicting through the full year of 2026, it's going to hang out at about 2.8%, outperforming most of what economists have forecasted. So I think that's really interesting. GDP has a lot to do with the cost of money. It's the measure of growth of our economy. And like I said, we want to grow it at a rate that consumers can keep up with. So that's why it's important for it to be at 2%. You don't want GDP to be like 10% or something, because then it would be growing so much that consumers can't keep up with it. And that's when things start to go off the rails. The cool thing, so how are they coming up with this projection? Basically, this projection, this is what the historically has looked like for GDP. In 2024, we were at about 2.4 to 2.7% GDP all year long, which was stronger than expected coming off of COVID. 2025, GDP contracted a bit, 1.9% to 2.2%. It was contracting, but still healthy. 2026, as you can see, we just talked about that. And then they expect that trend of growth to stay around 1.6 to 1.9% in 2027. Basically, what Goldman Sachs is saying is that they're predicting a soft landing for our economy. We are not looking at a recession. We're also not looking at a boom. It's kind of a boring economy, if that makes sense, which is actually bullish. In simple terms, that means that inflation is falling. Fed will cut rates slowly, not dramatically. Job markets will weaken slightly, but still stay positive. We'll talk about that in a little bit. Housing stabilizes and GDP keeps growing. So basically, economists call this trend growth. It's just sort of like the natural cruising speed that you ideally want to be at in our economy. So that's good news, right? We're kind of like getting off of the bumpy turbulence and getting more to a cruising speed. So why does this matter for us? Well, it definitely is one of the most important signals that you can watch as an agent. If Goldman Sachs is right, which I don't have a crystal ball, but they normally know their stuff. What's great about it is this is a housing recovery year is what they're predicting. Definitely not a crash year. We don't have to worry about that. So that's really fantastic. But basically, it's a stabilizing year because based on this trickles down to lower inflation, which means mortgage rates will drift down. Fed cuts, which means buyer affordability will improve, hopefully. No recession, which I don't think any of us are probably too worried about that, but good to know in case people are still asking about that. It just means people don't have to panic list as much. We don't need to worry about that looming. And population growth, demand will stay strong in the Carolinas based on everything we see. So that's good news for GDP. Let's talk a little bit about inflation. This graph is direct from KW Research. And so based on the US Bureau of Labor and Statistics. So you can see this is inflation all the way, whoopsies, all the way from the 90s through today. And you can see it's been quite interesting, quite interesting. Currently, inflation is at 2.7%. Remember, the target is 2% for inflation. Direct quote from Goldman Sachs about this. Goldman Sachs expects core PCE inflation to fall to 2.1% by December 2026. And core CPI inflation, which means like things people actually purchase, like food, energy, that sort of stuff, to slow towards 2% as tariff effects fade and price pressures ease. So basically, this means inflation is not disappearing, it is normalizing. So we're not, what you see here, this whole dramatic, yeah, roller coaster we've been on, that is normalizing and should be steadying out. The economy is essentially moving from overheated to stable. And this is what a soft landing actually looks like. A great talking point that you can talk about with your clients when it comes to inflation is prices are not stabilized, or excuse me, prices are not spiraling anymore, and we're not seeing economic free fall, we're stabilizing. So talking on your social media and to your clients about, hey, here's what the numbers are at right now in our economy, and this means we're stabilizing. Nobody panic. I think the last 5 years in our country, people have almost become conditioned to panic because things have felt so volatile since 2020, right? Up, down, up, down, up, down. Everything's back and forth as far as the economy and the market goes. And so to help people understand, hey, we're moving into essentially the new normal to stabilize is a great message to help people understand. And as inflation continues to move closer to that magic 2%, it's exactly what the Fed wants. That's going to increase the likelihood. Now, remember, we can't make any promises. This is not a crystal ball. But as inflation continues to move towards that 2%, cooling inflation increases the likelihood that the Fed rate will cut rates, or at least have more stability and not any hikes. So a little background, as inflation stays really high, typically the Fed will not cut rates because they want people to essentially stop spending so much money. They need people to sort of like rein it in. And by cutting rates, of course, that would increase people's tendency to purchase homes, right? So now that inflation is starting to cool, it makes it more of a friendly environment for Fed rate cuts, although we're not going to be looking at anything dramatic, right? So when you're thinking about mortgage rates and stuff like that, we'll talk about that at the end. But I think we all know, but just in case we don't, the world of a 3% interest rate on a mortgage is no longer going to exist. So don't hold out hope for that for yourself or your clients. But that's what's cool is right now, because of what's coming, most likely with Fed rate cuts this year, mortgage rates tend to move based on expectations of those things, not on the actual announcement of those things. So basically, what we'll start to see this year is that rates don't have to be insanely low in order to unlock activity. They just need to be predictable. One of the things about human nature is that we all want certainty. Naturally ingrained in our wiring. We want certainty, we want predictability. Well, one of the reasons and factors why we've seen clients, buyers, hesitating on buying and all those things is because things don't feel predictable. And when things don't feel predictable, buyers start holding out for something to get better. Sellers start holding out for things to go back, right? And so the predictability that we're looking forward to is going to really, really benefit us. It's also really important to think about with inflation, as we're looking at this number going to 2%. Inflation does not mean that cost of living is going down. In fact, there was a study that I read last year that basically proved that, easy layman's way to say it, once cost of living goes up, prices go up, it's really, really difficult to get them to go back down because businesses adjust to those things. And so this is important to clarify with your clients. Lower inflation means prices are rising more slowly, not falling, right? So you're still going to have price appreciation and price increases. It's just going to be more slow and steady and normal instead of these crazy spikes. So waiting for prices to go back down to 2019 is unrealistic. It's just like not a thing, right? Real estate is still going to be one of the strongest hedges against inflation long term, because it still continue to appreciate. But it is going to go back to being more of a long-term game, which in the last 5 years, you got appreciation much faster. So waiting for prices to drop dramatically will be riskier. It's almost to help your clients understand this thought. When a client says, I'm going to wait for prices to drop, that's actually riskier than waiting and then just buying in a stabilizing market, because prices are not going to drop. And if they wait a year, they're going to pay more than they did this year, right? In home value. What is the signal for consumer confidence? Well, the great thing about this is when inflation stabilizes, consumers feel less financial stress. Because where do we feel inflation the most? Often we feel inflation at the gas pump and at the grocery store, right? That's two of the strongest places that we feel inflation, and also travel, like flights, airplanes, that sort of thing. And so when this stabilizes, people feel less stressed because the gas pump is not as painful, the grocery store is not as painful, and that predictability will then restore confidence. Confidence drives moves. When consumers feel confident, they are more likely to make larger purchases like homes, make moves like selling. And so after inflation stabilizes, this is often why we could be seeing a pent-up demand release coming this year. I think one thing that's another important point to think about when you're talking to your clients about inflation, again, this is great for social media, great for conversations with your clients. People don't move when they're scared, which when things are unpredictable, it feels scary, right? So that has a strong connection to what we've seen in the last year. People don't move when they're scared. They move when things feel understandable again. They move when things feel understandable. People don't move when they're scared. They move when things feel understandable again. And things are starting to feel understandable, which gives us a positive outlook for 2026. Housing will thrive in this more boring and stable environment. So, yay. It's basically just not going to be a frenzy market, which is actually a great thing. Frenzy market, in my opinion, creates sloppy agents and sloppy transactions. So, I do want you to think about this again as you're talking with your clients and you're thinking about things like inflation and GDP. This is the type of market where if you can present yourself as the expert in these things, you will build confidence with your sphere of influence. People who are going to win right now are agents who can explain things like inflation simply. You will win trust. And remember, that conversation is not about predicting the future, it's about reducing fear. Calm, educated agents are going to convert more clients right now than optimistic hype artists that are just all over social media looking flashy. So don't be intimidated. Don't compare yourself to those things. If you can explain inflation in 30 seconds or less without jargon that somebody can quickly understand, you'll win the appointment and you'll win the confidence of your client. So remember, inflation is not a headline. It's a signal that stability is returning. Well, inflation easing. Inflation easing is not a headline. It's a signal that stability is returning, and stability fuels decisions. Awesome, right? Okay, so let's talk a little bit about unemployment levels. So I love this chart. This is all of the unemployment data from the Bureau of Labor Statistics from '05 to now. Now remember, 2246. So unemployment, the goal for unemployment is to be at 6% or below in unemployment. Currently, we're at 4.5% unemployment, and Goldman Sachs expects this to stabilize at around 4.5% for 2026. Why is unemployment goal around 6%? Well, essentially, it's almost impossible for an economy to have 100% employment, right? Like what this is accounting for is essentially to say when you're below 6% unemployment, it's essentially saying that pretty much everyone who wants to have a job has a job, and some of that percentage of unemployment also contributes to entrepreneurs. People that are self-employed will not count in the unemployment stats. But basically, everyone that wants to have a job has a job, which is fantastic for our economy. Obviously, there's a very slight increase in unemployment. It was 4.4% in December, right? 4.5% now. It's a very small increase. That's just continued stabilization. We're coming off historically tight labor conditions, as you can see, looking at April 2020, that lovely red circle. That's where we had a humongous spike in unemployment. And I mean, it has gone down and sort of hung out around here since 2023. But that is all about rebalancing. The job market is stabilizing, which is fantastic. And it was stabilizing, honestly, all through 2025 as well. So what you'll see when it comes to this is, again, if anybody asks you, hey, do you think recession's coming? All those sorts of media headlines that clients will ask you about. No, recessions typically show sharp, fast job losses. That's not happening. It's highly unlikely to happen because we're already below 6%. Everyone that has a job, that wants a job, has a job. Most job reductions right now in the unemployment numbers are just from hiring slowdowns, fewer job switches, companies becoming more selective. So that's the thing. And I don't have a lot more else to say about unemployment. However, I am excited to come back around. So I'm going to family reunion at the end of this month with Keller Williams, and there will be a huge industry update with Gary Keller at family reunion and a lot of training around AI and social media. And I'm only saying that to say when we do our next industry update together, I'm excited to talk with you guys about AI and look at how that is going to impact unemployment numbers. It's nothing to panic about, but it is something to be aware about that potentially as AI continues to evolve, AI will replace some jobs and people are going to have to think differently about how they make their income and about what they do for a profession in some categories, right? So I just think that that is just important to know, right? So stable jobs equal stable buyers. The low unemployment rate is fantastic for the housing market because everyone that wants to have a job has a job, which means you've got more stable buyers, more opportunities for people to get lending, financing to buy a home, and all of those sorts of things. So, because you've got that balance in the unemployment, you're also looking at fewer impulsive moves, more deliberate decisions. Um, the when you think about buyer consumer behavior too, when it comes to looking at this type of data, I also want you to think about like buyers and sellers, but definitely buyers want data, they want clarity, they want strategy, and this is how you can help them with that. Sellers, obviously, as we know, care more about well, we haven't seen this in 2025, but we predict in 2026, you're going to start to see sellers caring more about pricing their listing, their home correctly, not testing the market. In 2025, I think we could all agree, we saw a lot of sellers wanting to test the market. Let's just see what we can get. They still were holding on to that hope of being able to sell for the same price that you could sell for in 2022. And based on the days of on market and price reductions we've seen in 2025, thankfully, sellers are starting to catch up to the reality that this is a thinking market. It's not an emotional one. And, we can price your home to list or we can price your home to sell. So that's really what you want to focus on when you're speaking to your sellers and your buyers. You want to think about educating them, giving them that calm leadership. And when it comes to the headlines around unemployment and all of these things, if you sound more calm than the headlines, you will win the trust. So, a stable job market supports stable housing decisions, and stability creates opportunity. That's awesome, right? In my opinion, we're coming into a year of opportunity in 2026. So, that is fantastic. Let's talk about home sales a little bit. How is this going for you guys? Put in the chat if you're loving this information or if you have questions. I would love to see that here at the end. But this is what our home sales have looked like annually since 1969 to now. Now, I'm just going to talk about the last few years, but basically, because I know not all the numbers are included here, what are we looking at? So in 2023, we had about 4.1 million annual home sales in the United States. 2024, we were at 4.3 million. 2025, 4.06 million, which 4.06 million was extremely low. As you can see, that was lower than even 2008. So 2025 was a wake-up call. People did not, even this time last year, they were predicting that we would have higher home sales than 4.06 million in 2025. So that definitely kind of hit a bottom for us in the more recent future. Essentially since like the 90s. And then 2026, they're projecting 4.25 million in annual home sales. What that means on one hand is that like essentially we're not looking at some dramatic increase in home sales. It's going to hold steady around that 4 to 4.25 million projected. It's a gradual increase in existing home sales, not anything too crazy. So it's just good to know, right? Now, let's look at how that compares to home prices. Let me move this little screen a little bit so you guys can see. I'll move it over here for a second. Okay, so this is home prices annually, home prices, right? So we just look at how many millions of homes sold. Now we're looking at what the pricing trend looks like. So this is from 1990 through today, as you can see. The blue line right here is the long-term trend. So that's basically saying no matter what, just based on natural price appreciation and home value appreciation, all those things. This is what your natural trend should look like, just generally speaking, right? Now, as things in the economy fluctuate, you'll see there was a period of time where we were below that trend and home prices were in the tank. That was after '08. Ever since 2020, home prices have been above that price trend. We're currently at 5.4% above the trend. So as you can see in 2023, this is the nationally, right? In 2023, our average home price was 390,000. 2024 was 398,000. 2025 was 414,000. And they project that 2026 is going to be 423,000 as a projected average home price. Now it's definitely at a slower pace. So what you're seeing here is like how it went from 297 to 351 year over year. That was a very dramatic price increase from 2020 to 2021. So if you remember what we were talking about with GDP and inflation and unemployment, I talked a lot about how a lot of things are stabilizing and slowing. It doesn't mean that prices are going to tank or anything like that. It just means that you're not going to get that dramatic emotional spike in prices. And so that's what we're seeing here. 414 to 20 to 423 as an average home price is getting closer to that blue line. As you can see that trend, it's getting closer to stabilizing and just kind of becoming that baseline. And essentially, that's fantastic because the reality is when you think about the economy, why do we get into so much trouble 2021, 22, et cetera? It's because double digit appreciation is not sustainable. The cost of living, salaries, and everything else cannot keep up with that. And so it's really important. Slower growth like this is fantastic. It creates healthier markets, it creates fewer housing bubbles, which of course we don't want, and better long term equity. Now, this does also mean that you're going to have slower appreciation. So you're going to see people across the board that maybe bought in 2022, 23, and they are going to be in for maybe more of a rude awakening of what their home equity and like what they can sell that same house for if they need to turn around and sell it 2 or 3 years later. You know, they're not going to have that same equity they can cash in on. There's a lot of scenarios in that where people are having to sell 2 or 3 years after buying right now, and they're having to bring money to closing, or they're just breaking even. And so that's not ideal. So we're definitely getting back to um, real estate is one of the strongest wealth builders that you can have. And it's a long-term play. And we're getting back to that long-term play. That's what you're seeing here. Slower appreciation does not mean no appreciation. Essentially, it means safer appreciation because what you also could end up with those spikes in appreciation is spiking down the other way too, right? So remember, it's not a price decline narrative. It's just appreciation is slowing, prices are not falling. Most markets in the country, including the Charlotte market, of course, is going to see flat to modest gains, normalizing after that extreme growth, and just allowing prices to catch their breath. What's great about this for your buyers is, of course, as we've seen, buyers have more negotiating power. They're going to have more confidence to do the due diligence and not rush into a purchase, right? They're not going to feel that competitive pressure quite as much. However, at the same time, it's really important to help your buyers understand that waiting for a massive drop in prices is just going to cost them more, right? So there is no waiting for prices to drop. It's, do you want to buy now and just hold it for longer? Almost to say, think about the statement that you could say to your clients. You don't need prices to fall. You need the market to make sense. So how do you make this market make sense for you right now? How can you make the smartest decision possible? What does this mean for sellers? Obviously, as you probably have heard if you've hung out with me in the last 6 months, we've talked a lot about pricing strategy, and pricing strategy really matters now more than ever. Homes that are selling right now are priced right, are well presented, meaning they're pretty. They don't need tons of fixing up. They're probably staged. They probably smell good, and they're marketed properly. So that's the key. That's your formula right there for your play as a listing agent. Are you pricing it right? Is it well presented? And are you marketing it properly? When you're doing that, you're going to be good to go because it's a pricing market right now. It's not a list and pray market, if you know what I mean, right? It's a be strategic and price effectively market. Now appreciation still matters a lot, right? Because what's fantastic is you're still going to see that same price appreciation, just more conservative. So 1 to 2% appreciation year over year in your home purchase still compounds over time. It still protects you against inflation and it still builds real wealth. So I think it's a really important thought shift to help your clients with right now that real estate is not a get rich quick play. It's a get rich slow and steady asset, right? So stop. You can't, it's not that you need to stop selling appreciation, but do be very mindful of leading with buy now so that you can take advantage of appreciation because you don't want people getting into that hot bucket of we bought now we need to sell 2 years later and we're in a pickle, right? Think more about right now shifting to selling more around lifestyle. What do you want your lifestyle to look like? Stability, strategy. What's the strategic long-term stable play for making this home purchase or this home sale right now? So healthy appreciation creates sustainable wealth, not headlines. Okay, let's keep it rolling. I hope this is helpful for you guys. This is inventory annually. I didn't have a lot to say about this. You can see we're right here at 4.2 months of supply nationally. We actually talked about this in a mastermind the other week that honestly, if you've heard, probably remember from real estate school, right? 6 months of inventory is considered a balanced market. So technically, this is still considered a seller's market, but I know a lot of agents would say it doesn't really feel like a seller's market because buyers have a lot more negotiating power right now. So we'll keep our eyes on that, but there's a lot of conversation in saying that perhaps a balanced market is closer to 4.5 months of inventory versus 6 months of inventory. So it's just important to be mindful that right here, you need to be advising your sellers that yes, it's a seller's market, but that doesn't mean that you just have all the cards and you're going to get whatever you want, right? As we start inching closer and closer to that 6 month mark, you're going to see less and less of that. Okay, let's talk about this slide. Now, this is from our quarterly State of the Market event held by Andy and Leslie Peters with the Legacy Group. And I love this slide. And so I wanted to talk a little bit about it. One of the things I love about that event that they do is that they use a partnership company with data that takes all the national numbers we were just talking about and drills it down into the local Charlotte market, down to quarter, down to pricing category. We're not going to talk about all the slides, but I did want to talk about this one because this is it's called the party chatter slide for a reason. It's sort of like to say, when you're hanging out and people are like, how's the market? Which we all know people ask us all the time. These are the things that you can quickly talk about to demonstrate that you are an expert, you're the economist of choice, and give people something that's really actually helpful for them. So I'm going to explain what we're looking at and what these mean for you. So we're going to talk about cumulative monthly sales first. As you can see, it says year-to-date sales overall monthly sales were up 2.3% versus last year. So basically what this graph is saying is that we're slightly up year over year, right? Sales activity did not fall off a cliff. It steadily climbed throughout the year. Despite higher rates, noise, all the things that were going on, more homes sold this year than last year. The market found its footing and kept moving. So, all the hype about things falling off a cliff is just not real. This is proof when you're talking to your clients or at people at a party that want to say whatever the headline is that they heard on Facebook or the news channel for the day. This is proof that demand did not disappear. Demand did not disappear. It just adjusted. There's still demand. Houses are still being bought and sold every single day. It's just the approach to it is a little bit different. People did not start moving, especially not to the Charlotte market. They're still moving here. They're just becoming more intentional. And because people are not working from home as much as they were 3 years ago, they're coming into the office more. Their location geographically and the lifestyle that they're looking for is more impacted. So there's no dead market in Charlotte. We know that for sure. It's just a skills-based market right now for you as an agent, not a luck-based one. And that is so important. Your clients are not going to get lucky on, a random lowball offer 99% of the time to get a house. And your sellers are not going to get lucky with a random overpricing position on their house, right? It's a skills-based market, and that's our responsibility as agents to bring that skill to help our clients make the most educated decisions possible. Let's talk about median sales price next. So as you can see, the median sales price in Charlotte is actually higher than the national average. 423,000 for the end of 2025 was our median sales price. It's up 3.2% year over year. Basically, this graph is telling us, now you'll see, by the way, you've got 2023, 2024, 2025. So it's showing you each quarter and then overall. That makes sense? Basically, this is saying prices are continuing to rise, but at a healthy, controlled pace, which we just talked about. That's exactly what we want. So there's no boom, there's no bust. It's just nice, healthy, steady appreciation in the Charlotte market. And so that is, again, why it's important to help your clients not run to extremes. This is reality. This is exactly what a sustainable market looks like. Price growth this past year in the Charlotte market did not rely on a frenzy. It relied on fundamentals and started going to that natural price appreciation, which is much more slow and steady. And equity, that's why it's still a fantastic time to buy and why owning a home is still the best way to build your wealth because equity is still being built just without the chaos and volatility, which is actually a fantastic thing. It might be a little less exciting and a little more boring for the news cycle, but it is less chaotic, which is fantastic. So let's talk about median percentage of original list price down here. So this is talking about how much did the home actually sell for versus what it was listed for, right? And that number is 96.2%. It's down almost a full percent, 0.9 points, 0.9 since last year. Basically, what is this saying to you overall? And that's really interesting when you look at from 2023 to now. I don't know about you guys, but it's like interesting because 2023, 24 stayed the same, and then boom, it started to go down in 2025. It basically is saying that sellers are no longer getting whatever they ask. We know that, but it's really important to help your sellers understand that. Buyers have regained a lot more negotiation power, and that pricing strategy really, really matters. So it just makes me sad sometimes when I see agents take a listing because you kind of feel like you need the listing. And so we just say yes to whatever, only to pour all this money into marketing it and promoting it and showing it and doing open houses to not sell and then be chasing the market with price reductions. So I know that that's sometimes easier said than done, right? Sellers want what they want, but that's why this information is important because you can empower yourself with education to then empower your clients to get them the result they want. What you can say about when you're talking about this slide and people are like, how's the market? Well, the median average amount that people are getting for their house is about 96.2% of their list price, which is down about a percentage point. And that means that this is a return of normal negotiation. The gap between list price and sales price is healthy but not scary. And homes that are priced right sell. Overpriced homes sit. If you were to do nothing else this week in your conversations, that statement alone can empower you and empower your clients. Remember, homes that are priced right sell. Overpriced homes sit. Which one do you want to be? How long do you want to be getting the kids and the dog out of the house for a showing and cleaning everything up last minute or wondering when you're going to have an offer come in? That's the key. Overpriced homes sit, homes that are priced right sell. The market is essentially rewarding realism. Realism, because remember, what a house is worth is essentially what somebody is willing to pay for it that day, right? Like just because a house sold 6 months ago for a certain price does not mean that the house in that neighborhood is currently worth that price, right? And so when you're looking at your comps, it's really important to be pulling comparables for your clients. I personally would recommend, yes, look at some of the past 90 days comparables that closed so you can see how much price reductions did they have to take, where did they end at, and all of that. But also, I would be pulling comparables of active listings. Where are they listed at? How many days on market do they have? What are they coming soon? So you can really kind of get a feel for the temperature, not just what's closed, because overpricing is a punishment to us and to our clients, right? It is not fun at all. Okay, median days on market, and then we're going to keep it rolling. I hope this is helpful for you guys. Median days on market. Right now, our median days on market in the Charlotte metro area is 39 days. Now, of course, during this State of the Market event that Andy and Leslie Peters did, we get into days on market in price points too, which is really fascinating. But today, we're just looking at this median days on market overall. It's up 9 days year over year. That's quite an increase. It basically means homes, as we know, are taking longer to sell, but they are still selling. We're not having a crazy spike in expired listings, which is a good thing. Things are still selling. They're just taking a lot longer. Buyers are slowing down. They're not panic offering, right? So many of us have probably seen a buyer that maybe looked at your listing 4 or 5 times before making an offer, or are waiting for the first price reduction to make an offer. They're not backing out. They're just slowing down. And that's important for us to be mindful of. It's important to know more days on market does not mean less demand, right? There's still demand. It's just different demand, right? It's not panic demand. Um, and buyers feel more empowered. They don't feel rushed. That changes how you promote a listing. Time on market is normalizing, not exploding, which is also good. The average days on market is not 100 days or something crazy like that. So just remember, this is a thinking market. It's a strategic market, not a panic market. So if you take all four of these slides right here on the party chatter slide, what do these mean? Like, how do you sum this all up? Well, here's how I like to think about it. When you look at these four graphs together, like as a holistic whole story of the market, the story is clear, right? Homes are still selling, prices are still rising, negotiations are back, and buyers are taking their time. That's really sums up our market right now. That's not a broken market. It's a balanced one. It's moving towards more balance. And it's the kind of market where professionals will thrive and where strategy really, really matters again. And so when you're advising your clients or when people are asking you, that's a great elevator pitch that you can say to someone, hey, you know what? It's really interesting right now in the Charlotte market. Homes are still selling, prices are still rising, negotiations are back, and buyers are taking their time. And this is where working with the right agent really matters because strategy really matters right now. By the way, you want to grab coffee and talk about what your home could be worth, right? So that's how you can be talking about that. Okay. The next thing we're going to spend a real little bit of time talking about mortgage rates. I say a real little bit of time because I'm not a lender, first of all, and mortgage rates are a whole thing, right? As much as we would all, and I kind of talked about this already, as much as we would all love for them to go back down to, below 5% or even in the low fives, it's not really a realistic thing to be thinking about right now. This slide and data, by the way, is from mortgagereports.com. And I'm just going to read to you what they said because I thought it was pretty interesting. So it just says the 30-year fixed mortgage average, the 30-year fixed rate mortgage averaged 6.11% as of February 5th, according to Freddie Mac. So 6.11% is the current 30-year mortgage rate. Only one of the five major housing authorities we looked at predict 2026 opening quarter average to finish above that. So that means they're not predicting rates to go up, right? National Association of Realtors sits at the low end of the group, projecting the average 30-year fixed rate to settle at 6%. Meanwhile, the National Association of Home Builders had the highest Q1 forecast of 6.14%. What do we take from that? You can put it in the chat. I'll tell you what I take from that. Settle on in. That's what I take from that. We're probably looking at for 2026, plan to hang out at about 6%. It's not likely that things are going to drop into the low fives. It's not likely that they're going to spike. Remember, this is a stabilizing year. So settle on in. I would tell my clients waiting for things to, excuse me, to stabilize or suddenly drop 6 months from now is not a very realistic expectation. And even if it did, I'm sorry, I had to clear my throat. Lord have mercy. Even if it did, like let's say it went from 6.1 to 6, that's still not dramatic, right? It's a small change. So there's nothing dramatic that's going to happen with mortgage rates, which means you might as well just go ahead and get the show on the road, right? I did talk about this slide. Okay, I couldn't remember if I put this in here or not. So the price reduction effect, this is days on market based on price range. And I just love this slide. And I wanted to pop it in here to remind you of this because remember, we talked about over here, median days on market at 39 days overall in the Charlotte Metro. Now, based on price point, you can see this is saying if you price your home correctly, so why are we getting that average of 39 days on market? It's based on the houses that are selling very quickly and the houses that are staying on the market a really long time, right? So if you price your home strategically and effectively and price it to sell, you're looking at an extremely low overall median of 8 days on market to sell. That's the median overall right here is where you'll see that number. And you see it's based on category. So the 300,000 price range, 400,000. That's if it's priced correctly, priced to sell, you're looking at very quick days on market in the Charlotte market. If it's overpriced and it's going to have to start taking price reductions, it is a massive penalty in time, 11 times plus more time if you miss the price. Holy smokes. It goes from an overall median of 8 days on market to a median of 88 days on market if you are having overpricing and then having to reduce. So this is a really great slide to be talking with your clients about when you're at a listing presentation and they're like, well, yeah, we get all that, but why don't we start at this number because that's exciting to us, and then we can always reduce if we need to. Let's see how it goes. And you can say, okay, Mr. and Mrs. Seller, thank you for that idea. And I just want to make sure that you're aware we can do that. However, there is a dramatic change in days on market, what we're seeing if we price high to see what happens and then reduce as needed. Once you start having to have price reductions, Mr. and Mrs. Seller, you're looking at, let's say they want to sell their home for 800,000 and you think it's probably worth, I don't know, 750 or something. Well, Mr. and Mrs. Seller, based on your price category and the averages in the Charlotte market, if we price it too high at 800,000, you're looking at an average of 87 days on market before we get offers and get this sucker under contract and closed. Versus if we price it effectively, strategically, you're looking at just 5 days on market. How quickly do you want to be under contract? Like what happens? I know you said, your other home that you want to move to, or you got a job relocation in 2 months. What happens if we don't have this house sold in 2 months? That's a real possibility if we don't price it correctly. So you've got to take people to that reality of what does this mean for them and why is it to their strategy and to their benefit to price it effectively? And I always think it's also important to remind people, like you can price it, like if they're like, yeah, but we don't want to take anything less than you want us to list it at 750. We don't want to take anything less than 765 or something. You can say, well, hey, remember, you can just because an offer comes in, you don't have to accept the offer, right? Like you're not required to accept the offer. So you might as well price it low so you can get more eyes on it, more traffic, more offers, and then see where it goes. Okay. The market doesn't reward speed or hype. It rewards clarity, strategy, and professionals who can think. I don't have any slides about this, but I just wanted to say a few things and then we'll wrap it up and you guys can ask me any questions if you want. But when you're going back to this listing strategy and to this party chatter slide and talking about when you have your buyers and they're thinking about, well, we heard that rates are going to drop really low in June, so maybe we'll wait till then. I have this really great script. This is from Ben Kinney, who is a master in the real estate industry. Go look him up. He is just incredible. He has built a multi-billion dollar entity within real estate. And anyways, this is his script that he shared with me a couple years ago about this. And it's super helpful. So I'm going to tell it to you, write it down, and remember you'll get the recording so you can jot it down later too. But when a buyer says, I'm going to wait because I think prices are going to drop or rates are going to get better and they're going to come down in the next quarter, you can say, wow, that's interesting. I'm curious, where are you getting that data? If I could show you some data from Goldman Sachs that shows that what you're thinking is not the case, in fact, it's the opposite, would now be a better time to consider making a move. So remember, you're leaning into the data. You're not leaning into emotion and opinion. I'm right, they're wrong. We're talking about data. Where'd you get that data that made you think that interest rates are going to go down or prices are going to go down? If I could show you other data that might give you a different perspective, would you want to talk about that? When someone says they're not moving, you have more power to persuade them and help them think the way you do. And that's where I feel like that's our duty as agents, is to help people see and be educated on what the market is really saying to us with their best interest in mind, right? I also wanted to say this is a fantastic time to be thinking about your client and customer and database experience. If you have not already enrolled, if you're in Keller Williams at our office, I know there's other people on here from other brokerages and things, but if you're at our office, we have an automation smart plan that you can get your entire database plugged into. They'll get a customized branded newsletter from you every single month, as well as our monthly neighborhood nurture every single month, where they get market data stats on their specific neighborhood. And it's probably the one thing I would say everybody needs to be using. It costs you $0. And it helps you not only continually show up as the economist's choice in their personal neighborhood where they're interested most, right? People want to know, what did my neighbor's home sell for? What's my house worth, right? But it also gets them off the other search sites that are out there. Because recent home sales on these other search sites is the number one thing they're looking for. Instead of them going to search for it, you're going to email them every time a home comes on the market and sells in their neighborhood, and it keeps them with you instead of on another site where they can be picked up by, 8 other agents in 3 seconds, right? Remember, the average consumer knows 9 realtors. When they're ready to buy, sell, or invest, 86% of them call one. In order to be the one that they call, people need to hear from you every 15 to 21 days. You've got to be top of mind. And that's what that automation smart plan is for. The other thing I wanted to say before we wrap this up is that right now you really have a huge opportunity to take market share when it comes to mastering presentations, because there's a lot of agents out there that just don't feel fully equipped for how to talk to clients. They might understand the data themselves, but how are they talking to their clients about it to help them as well? And so it goes back to a conversation that I learned from Ben Kinney a while back, and it's so powerful. So I'm going to tell you exactly what he said. This is what you say when a client says they want to wait. Again, they want to wait for rates to drop. They want to wait for interest rates, blah, 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 right? You simply say, can I show you the math? I really think the math will help you make an educated decision. Goldman Sachs and all these other experts are showing us that home prices are going to go up by about 5% this year. So let's take a look at the cost of the home increasing for the, let's take a look at the cost of the home, the price increase for the home that you're buying. Okay. So you want to buy a $600,000 home. It's going to cost you $30,000 more in home value, right? In the price of the home if you wait 1 year. If you wait 2 years, it's going to be about $63,000 in increased home appreciation and real estate appreciation. That's a lot. If you wait for rates to go down, if rates were to go down by 1%, which is highly unlikely this year, at most, they'll probably go down by 0.5%. But you said you want to wait for rates to go down by 1%, and that's your goal. That's going to save you 10% of your monthly payment. 10% of your monthly payment is $300 a month. $300 times 12 is $3,600. So yes, by waiting, you could potentially, if rates go down by that amount, you would be saving $3,600 only to pay $50,000 or more for that same home in total home price. Mathematically, that doesn't make sense, right? And then you can say, and by the way, here's what I think we should do. Let's get you into that home that you love now so you can afford, let's get you into a home now that you can afford. So like if the price of 400,000 or 600,000 is too much for you right now based on interest rates, what's the home price that you can afford? Let's get you into that home that you can afford so you don't have to pay more in the future, because we all know a 30-year mortgage, right? You're going to pay a lot more with interest and everything. And I'll work out a deal with my preferred lender where we can figure out how to get you maybe some buy down points or some other things that different lenders can offer. And then, of course, as the market starts to change, we can refinance. Does that sound like a fair out? And you can even say, I'll put a note in my CRM and send you a message. Now's the time to refinance. So you don't even have to think about it. Does that seem like a fair option for you and your family to save you more money? So I know that's a long dialogue, and I can type it out if you guys want it as well, so you'll have it in writing. But that particular dialogue was really helpful for me when thinking about how to talk to clients about the market right now. Because remember, your job is to help keep people out of emotion. Real estate is one of the most emotional transactions that people make, and you want to pull them out of emotion and into logic so they can make the best educated decision for themselves, their family, and their future. This market does not reward speed or hype. It rewards clarity, strategy, and professionals who can think. And that's you. So that's what I have for you guys today. Let me stop the screen share real quick. What questions do you guys have? Any questions, comments? I hope this was super helpful for you. Awesome. Sabrina said very helpful information. Of course, you'll get an email from me with the recording, the slide deck, and any other resources. If you guys want me to send you some of those dialogues that I was telling you at the end, referencing the data, I can. Any questions, comments, anything at all? How do you guys feel after that information? Yep, no problem, Mayhew. I will type it out for you and send it to you. Awesome. And by the way, those dialogues that I shared at the end can make great social media reels and YouTube videos as well, right? Like those can definitely be scroll stopping things to say that can really help pull people in. I hope you feel empowered by this information. Remember, 2246, that's your magic formula. Any given day, go Google those things, GDP, inflation, real estate appreciation, and unemployment, and it can really empower you with those ongoing conversations. Awesome. Okay, guys, absolutely, Tony. I'll make sure you have the information as well. Super helpful. It really helps to hear it and hear it again. Sophie, yes, I agree. Like hearing the data one time is never enough, right? Especially because it can change like month to month, quarter to quarter. It is always adjusting. So, thanks for being on, guys. I'll make sure to send you all the resources and we'll talk soon. Bye.